Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Risk and broking accounts for roughly half of Willis Towers Watson revenue, placing insurance for specialty risks including marine, aviation, construction, and financial lines on behalf of large global corporate clients worldwide.
Health, Wealth, and Career covers the other half of revenue. It provides employee benefits design, actuarial consulting, retirement plan management, and HR outsourcing to Fortune 500 companies around the entire world.
CEO Carl Hess took over in 2022, succeeding John Haley, who led the original Willis Towers Watson merger. Hess ran the investment risk and reinsurance division, bringing familiarity with both core business segments.
The 2021 Aon merger attempt was blocked by the Department of Justice on antitrust grounds. The substantial break fee received funded a self-directed transformation strategy focused on margin improvement and portfolio simplification.
The transformation plan launched in 2022 targets simplified portfolio operations, improved segment margins, and technology investment to automate both benefits administration and risk modeling workflows over a broad, extended, multi-year period.
Operating margin runs around 16% below industry peers like Marsh McLennan and Aon. The transformation targets meaningful margin expansion over several years through disciplined cost reduction and improving underlying revenue mix.
Revenue retention sits above 90% across both business segments, reflecting the high switching costs inherent in insurance placement relationships and deeply integrated benefits administration platforms serving large enterprise clients globally.
The dividend was cut following the Aon deal collapse and has been steadily rebuilt, returning to $1.72 annually in 2024, reflecting improving management confidence in the ongoing earnings recovery trajectory.
WTW advises approximately 86% of Fortune 500 companies in some capacity, a deep penetration level reflecting decades of careful relationship building across risk, benefits, and human capital consulting practices globally.
Marsh McLennan and Aon dominate insurance broking at scale. In benefits consulting, Mercer and Aon are direct competitors. WTW differentiates on analytical depth and service quality to retain blue-chip client relationships.
Organic revenue growth of 5 to 7% is the long-term target, driven by rising insurance premiums, benefits complexity, and expansion of data analytics capabilities across both core business segment offerings.
The international scale, spanning over 100 countries, is a genuine competitive advantage when serving large multinational corporations that require consistent and integrated risk and benefits advisory across diverse global geographies.
The long-term case rests on a defensible risk advisory position, improving margins through the transformation program, and a client base that is structurally resistant to switching, given deep operational integration throughout.
For financial sector investors, Willis Towers Watson offers a credible margin improvement story, high client retention, and secular growth through rising global insurance and benefits administration complexity and increasing market demand.
That's the company chapter for Willis Towers Watson. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Willis Towers Watson beat Q1 estimates and posted over $1.5 billion in annual free cash flow, yet the top-line revenue number is still declining. Is that a red flag or a deliberate transformation story? We're breaking down one of the world's leading insurance brokers, a company buying back shares aggressively while divesting businesses that don't fit its core thesis.
Willis Towers Watson is a global professional services company providing risk management, insurance brokerage, and human capital consulting services. Headquartered in London and Dublin with 49,000 employees worldwide, WTW serves clients in over 140 countries, helping them manage risk, employee benefits, retirement programs, and workforce strategies.
WTW went through a major strategic reset after its planned merger with Aon collapsed in 2021. The company pivoted to a transformation program, divesting non-core businesses, reinvesting in technology and buying back shares at an aggressive pace. TTM revenue is $9.7 billion, with organic growth in the 4 to 6% range, masking the headline revenue decline from divestitures.
Q1 2026 EPS came in at $3.72 versus the $3.65 estimate, a 1.9% beat. Revenue was $2.41 billion, in line with consensus. The beat was driven by better-than-expected margin performance in the risk and broking segment, partially offset by softness in health, wealth, and career consulting revenues.
On a trailing 12-month basis, revenue is $9.7 billion, down 2.2% year-over-year. That headline decline is entirely attributable to deliberate divestitures of non-core business lines. Organic revenue in the retained businesses is growing at 4 to 6% annually. Net income on a TTM basis was $1.6 billion, representing a strong 16.5% net margin.
The balance sheet shows a company in active capital redeployment mode. Cash is $3.1 billion, total debt is $6.9 billion, and equity is $8 billion, with total assets of $29.5 billion. The debt is manageable relative to cash flow generation. The substantial cash position reflects both operating cash generation and divestiture proceeds being staged for buybacks.
Cash flow generation is strong. Operating cash flow on a TTM basis was $1.8 billion. After $223 million in capital expenditures, free cash flow was $1.6 billion. That free cash flow yield of 6.4% on market cap is attractive for a company of WTW's quality and franchise position in the insurance brokerage market.
The stock trades around 305 with a market cap of $24.2 billion. The PE ratio of 20.5 times reflects the market's recognition of WTW's business quality and the irreversible nature of the insurance brokerage moat. The dividend yield of 1.28% is modest, as WTW is directing most of its excess capital toward share repurchases rather than dividends.
The buyback program is the capital return centerpiece. WTW has been repurchasing shares at a rapid pace. The share count has declined meaningfully since the Aon merger termination. At 20 times earnings, with over $1.5 billion in annual free cash flow, buybacks at these price levels are accretive for remaining shareholders and reflect management's confidence in the intrinsic value assessment.
Street consensus on WTW leans toward buy, with price targets generally in the $320 to $350 range. The transformation story has been playing out largely as management guided, and most analysts believe the organic revenue growth in the core broking and advisory business justifies an eventual re-rating once the divestiture noise fades from the headline numbers.
Insurance market pricing is the macro tailwind street analysts point to most often. The global insurance market has been in a hard pricing cycle. Rates have been rising across commercial, specialty, and reinsurance lines. WTW earns commissions and fees tied to insurance placements, so higher insurance premiums flowing through the market translate directly to higher revenue for the broker.
The human capital and benefits consulting segment is a structural growth opportunity. Companies globally are spending more on benefits strategy, workforce analytics, and actuarial services. WTW's Towers Watson legacy, the actuarial and HR consulting heritage, positions it well to capture that demand. This is a segment where technology tools and AI can enhance productivity without commoditizing the advisory relationship.
Revenue decline from divestitures is the key bear objection on the street. Analysts who maintain hold or neutral ratings argue that the organic growth in retained businesses is not yet fast enough to be confident the headline revenue decline is truly behind them. Until 2 or 3 consecutive quarters of positive reported revenue growth emerge, those analysts remain cautious.
Competition from Marsh McLennan and Aon is the structural competitive concern. Both Marsh and Aon are larger than WTW, have more resources to invest in technology and talent, and compete directly for the same large enterprise clients. WTW's smaller scale relative to its 2 largest competitors is a persistent disadvantage in certain market segments, particularly global account management.
The hard insurance market is WTW's friend. When insurance premiums rise, broker revenue rises proportionally, without WTW having to add clients or increase market share. The ongoing hard pricing environment in commercial and specialty lines is generating organic fee revenue growth that flows directly to the bottom line with minimal incremental cost.
The buyback program is value creating at current prices. WTW is buying back shares at 20 times earnings, a reasonable multiple for a franchise of this quality. As the share count declines, EPS grows mechanically even if revenue holds flat. That EPS growth compounds over time and creates a durable floor for the stock price even if multiples don't expand.
The transformation story has an endpoint. Once the remaining non-core divestitures are complete, WTW becomes a clean, focused insurance broker and HR advisory firm growing organically at 4 to 6% with excellent free cash flow conversion. At that point, the headline revenue declining narrative disappears and the multiple should reflect the underlying business quality more accurately.
Revenue trajectory is the primary bear concern. TTM revenue declining 2.2% is optically poor, even if explained by divestitures. If organic growth in retained businesses slows, from insurance cycle normalization or economic softness, reported revenue could decline for multiple consecutive years, depressing investor confidence regardless of EPS trends.
Talent attrition risk is real in professional services. Insurance brokerage and actuarial consulting are relationship businesses. Key producers carry clients with them when they leave. WTW went through significant disruption around the failed Aon deal. If that disruption triggered talent losses not yet visible in financial results, there could be meaningful revenue headwinds ahead.
Competition from Marsh McLennan and Aon is intensifying. Both competitors have been investing heavily in data analytics and AI-driven risk modeling. If WTW falls behind on technology investment while executing the transformation, it risks losing ground in client service quality, which in a relationship business is very hard to recover once lost.
Insurance cycle normalization is a medium-term risk. The hard pricing environment is not permanent. Cycles eventually soften as more capital enters seeking attractive returns. When pricing softens, WTW's organic growth slows proportionally. Timing that reversal is difficult, but investors should know it's coming.
Marsh McLennan is the gold standard peer, the world's largest insurance broker with a diverse portfolio of risk, strategy, and human capital advisory businesses. Marsh trades at a premium to WTW, reflecting larger scale, more diversified revenue, and a stronger organic growth track record. The valuation gap reflects the market's view on franchise quality differences.
Aon is WTW's most direct competitor and the company it nearly merged with in 2021. Aon focuses on risk, retirement, and health solutions at a similar scale. Both companies are pursuing digital transformation of the broking value chain. The Aon comparison shows what WTW's business could look like with deeper technology investment and greater scale.
Arthur J. Gallagher is the faster-growing mid-size peer, executing an aggressive acquisition strategy in specialty and middle-market brokerage. Gallagher's integration track record is strong and it trades at a premium on growth expectations, illustrating what the market rewards in the brokerage space when growth is consistent.
Brown & Brown focuses on middle market and regional insurance distribution with exceptional organic growth. It trades at a premium valuation. Across all peers, WTW trades at the most modest multiple, despite a top 3 global brand, and that gap is the core of the valuation bull case.
Options activity on WTW is moderate and mostly concentrated around earnings events. The stock doesn't attract speculative options flow because it's a steady professional services business without binary catalysts. Implied volatility is slightly above average, reflecting the ongoing transformation narrative uncertainty. Investors use options to hedge around quarterly reports where divestiture accounting can produce surprises.
Insider activity has been positive and consistent. CEO Carl Hess and members of the board have participated in open market purchases at prices in the $280 to $310 range. Those purchases signal management's confidence in the transformation execution and their view that the current stock price undervalues the intrinsic worth of the business they're building. That alignment is important in a story where investors need conviction.
Institutional ownership reflects a value and quality tilt. Major actively managed funds with a quality bias, the kind that favor durable franchise businesses at reasonable prices, have been accumulating WTW. Insurance sector specialists are particularly well represented, as they understand the broking economics and hard market dynamics better than generalist investors who see only the headline revenue decline.
The key catalysts to watch are quarterly organic revenue growth, specifically when reported total revenue turns positive year over year, as the divestiture comparisons fall out of the base. That inflection moment is likely to be a significant positive catalyst for the stock. Secondary catalysts include any insurance market pricing data and any announcement of additional share repurchase authorization.
Willis Towers Watson looks worse on the surface than it is underneath. Revenue decline is a deliberate divestiture effect, not organic deterioration. Free cash flow is strong, buybacks are aggressive, and the hard insurance market is a powerful tailwind for the core business.
At 20 times earnings with $1.6 billion in free cash flow and a top 3 global brokerage franchise, WTW deserves a closer look. Once divestiture noise clears, the re-rating potential is real. Patient investors get paid to wait.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.